you've already made huge progress on electric cars in particular. Your customers seem to love them. There's, Rivian has the highest customer sat. The shift to, software as the basis for the cars, you've already, it's like check. Autonomy is sort of like, semi-checked as you currently working on it. But one of the biggest sort of criticisms that comes from the investment community about Rivian is how Rivian has sort of like burned through a ton of cash to get to where it is today. It just doesn't know how to make money. You may have seen this chart that ex-user has made. They basically post this everywhere, that for anyone who talks about Rivian. And this chart basically shows that Rivian has lost, or the cash flow of Rivian has been negative 25 billion up to this point in time, 8 years in, or in the past 8 years, and it has lost more money. Many of these companies that have like come about trying to build EVs and do this disruptive technology have basically closed shop and have disappeared. What's going to get Rivian to get to that next stage? How do you respond to sort of like this and the fact that the yellow line in this chart has continued to go down and has not turned around essentially yet in order for it to become a viable company?
Yeah. Of course, the plan is.
I got to put you on the spot, by the way, and I'm a fan. I'm a shareholder, but I do want to know.
No, it's a great question. I'm glad I have a chance to speak to it. Ultimately, we wouldn't be building a business if we didn't plan for the business to make money. And so when we look at this cumulative cash flow chart, there's a couple of things to keep in mind. So the first is, in the early years, we had a bunch of unexpected market dynamics that we had to deal with that caused us to accumulate losses in a way that we didn't expect. So the most significant of which was the occurrence of COVID and then the subsequent supply chain challenges that came with that. And we had the disadvantage of when we sourced the components that go into our vehicle, we sourced them when the auto industry was at like an all-time high. So this is like 2018, 2019. And we had because the auto industry was thriving at that point, it was very hard to get great pricing. But we had to launch. So we had to accept what we would think of as like a significant premium on a lot of the components in the vehicle. And we did that with the confidence that when we launched, the volume that we'd be driving and the success of the product would allow us to renegotiate those contracts. That proved to be very different than how it played out, because when COVID hit, the premiums we were paying to get access to components that we knew we were paying, we thought we would be able to negotiate out, actually got worse because then we were just paying to get access. And so it was like this double compounding challenge of not having the scale to allow us to negotiate aggressive or reasonable pricing, and then further having to pay just to get enough parts to be able to run our plant. So that was like, call it in like the 2021, 22, or even into 2023 dynamic. And then I think the other thing that's really important to note, which is often when when you look at this chart, it normalizes everything to the year of when we started the business and started spending. And so you see they all have the same point on the left.
Right.
But it ignores the fact that we're not competing against Tesla of 2013. And from a customer point of view, if you buy a Rivian, you don't want to say, well, they're not investing in all these things and their R&D budget's really constrained because they're trying to compete against what Tesla was working on in 2012 or 2013 or 2014. And so, Tesla has the benefit of having grown to a lot of scale, and that scale generates revenue that then generates free cash flow that covers their OpEx, obviously, and you can see positive cash flow there. We haven't yet achieved the scale that corresponds to the size of OpEx business that we built. And said more like simply, we have a very large R&D budget, and we have a very large OpEx budget for building out the infrastructure to be a company that's much, much larger than we are. And this curve is not like a surprise. This is right. Capitalize the business. We raised capital to become a very large company. And we knew that we'd be going into this trough. That's why we had we raised a lot of money as a private company. We raised a lot of money when we went public. And so it has been the plan. As I said, some things have gone some things haven't gone exactly as we expected. Global pandemic, global supply chain challenge. But we always did expect to have to spend a lot of money to develop technology to be best in the world. And in order to allow things like the R2 to come in, and the R2's, the goal isn't to sell 50,000 R2s a year. R1, which is a flagship product, we went into that knowing that it was not a high volume product, but that it was our handshake with the world. It was how we introduced the company to consumers. As you said, the consumer satisfaction has been outstanding. The R1S is the best selling premium electric SUV in the country, but it's just it's a $90,000+ car. So it's not going to sell that many. R2, on the other hand, it's the first, in my view, it's truly the first time there has been a product that's highly compelling and priced similarly to a Model Y. Yeah, it's very different than a Model Y, of course, by intention. It's not trying to be a Model Y, but it's price-wise, it's very similar. We haven't announced final pricing. When you see it, it is like very, very similar. Performance is outstanding. And I think for the first time customers that are thinking, hey, I want to buy an SUV or a crossover for $50,000 or $45,000 or $47,000, there's going to be more than one choice. And the best reflection of the lack of choice there is the fact that Tesla still maintains 50-ish, Q4 of 25 was like 60+% market share, which doesn't reflect a well-served or healthy market. It reflects a market that's
doesn't have choice.
Doesn't have choice. And so in order for us to be launching something that I can say with conviction and confidence is highly compelling, it has required us to spend money on making the technology incredibly robust. And I think that's probably the least understood part of the business, is that like we're spending to become a very large company, and we're not a very large company until we have R2. Our R2 is how we get there. That's the key step.
Right.
And then
investing in yourselves.
R2 will start to pay for, generate the free cash flow to cover the OpEx that we've built in terms of R&D and some of the vertically integrated go-to-market functions.